The stock market is the great equalizer. It's an investment vehicle that allows you to buy a piece of a company, and because it's not tied to any one person or business, you have even odds of profiting from your investment. You can start small and grow your nest egg over time, or make a quick buck with a lucky bet on the next Amazon or Google. The trick is knowing how to navigate the world of stocks and bonds so that you maximize your chances for success, while minimizing risk. Learn the lingo. Before you begin investing, it's important to understand the difference between stocks, bonds, and mutual funds. Stocks are shares of a company that give you a small portion of ownership in the business. If the company does well financially and its stock prices rise over time, then your stock may be worth more than when you first purchased it. Conversely, if the company does poorly or goes out of business altogether, then your investment is likely worthless. Bonds can be thought of as loans that companies take out from investors. These loans usually pay interest over time until they are paid back at some point in the future, like mortgages. Bonds also have their own market value based on how likely people think it is that investors will get paid back for their loan with interest payments that exceed what they originally invested into buying them. Mutual funds pool together money from many different investors to buy stocks or bonds. Investors then receive dividends based on how well their investments perform, which is why they are called dividend-paying. Start with basic financial education. Learning about finance, investing, and business can be overwhelming. There are so many topics to cover and so much information to absorb that it can feel like a huge task just to get started in the first place. The good news is that if you're willing to put in a little work at the beginning, it will pay off big time later on. Start with the basics. Read books or watch videos on personal finance and investing. Start learning how to read financial statements such as balance sheets or income statements. This skill alone can help you make smarter investment decisions when selecting stocks during market downturns. Understand different types of investments. You can invest in a number of different types of assets to help protect your portfolio, including stocks and bonds. Stocks are shares of ownership in a company. When you buy stock, you own part of that company. Bonds are also a way to invest money over time and get paid interest on it. Mutual funds allow investors to pool their money together and put it into various asset classes, such as stocks or bonds. Investors benefit from the diversity that comes with having many different investments under one umbrella fund manager's management strategy. And they don't have to worry about picking individual companies themselves because they're already diversified through the mutual fund's investment choices. Learn how to place trades. The second step to buy stocks before the market goes down is learning how to place trades. Before you buy a stock, you'll need to open an account with a broker and then find out what your options are when it comes to placing trades. Know which brokers will give you the best service. The best brokers will have friendly customer support, a wide variety of investment products, and low fees. This means they can lead you through the process of investing in stocks without driving up your costs unnecessarily. Avoid scamming brokers at all costs. It's important that any prospective broker passes the smell test. If anything about their website or sales pitch seems fishy, and there are plenty of red flags, avoid doing business with them. Try to think long-term. The longer you hold on to stocks, the greater your chances of seeing them appreciate in value. This is why it's important to diversify your portfolio through investing in many different companies and industries. Note that diversification doesn't necessarily mean that every stock should be traded at different times. Some investors prefer to trade multiple stocks at the same time, so they have a broad range of holdings that can help buffer against losses during bad periods, while also providing gains during good ones. Avoid short-term thinking. When it comes down to making important financial decisions, don't let emotions get in the way. Instead, stick with what makes sense financially, and not just emotionally. For example, if someone tells you a stock rose 10% yesterday and now it's falling 20%, ask yourself if those are good reasons for buying more shares. If not, then don't do anything until after things settle down either up or down before making any decisions about where you want your money invested long-term. Avoid high-pressure salespeople or brokers. Avoid high-pressure salespeople. Also, be wary of brokers who are paid on commission and tend to try to sell you the most expensive products. Know your rights, know what you're buying, and know what you're paying for it. If a product sounds too good to be true, or if someone is pressuring you into buying something, get help from someone else. Don't put all your eggs in one basket or all your stocks in one sector. The best way to protect yourself from a downturn is by diversifying your portfolio. If you've got a large amount of money, spread it out over different types of investment and maintain a diverse portfolio. You don't want all your money in one company or even one sector. You may be surprised when you look at how many different companies are represented on the S&P 500 index. Some might be taken for granted by investors who don't see them as particularly important, but they're still part of the overall economy and can help keep your portfolio stable during times of market volatility. The most common way is through mutual funds, which pool together multiple investors' money into a single investment. Exchange-traded funds, which allow you to trade baskets of stocks, or index funds, which track particular benchmarks. You can also set up an individual retirement account or make charitable donations that will grow tax-free until you withdraw them later on in life for retirement savings. Be wary of hot tips and gimmicks that promise quick profits. When looking at a stock investment, you should be wary of hot tips and gimmicks that promise quick profits. They can be scams, they are often not researched properly, and they are usually not reliable. You might get lucky once or twice after following the advice of a friend or family member who knows something about investing, but more often than not, it's best to rely on your own research when deciding what stocks to buy. Conclusion: buying stocks is something that many people want to do, but few actually do. It's easy to get discouraged by the complexities of the stock market and decide that investing isn't for you. But it doesn't have to be complicated or scary. By taking some simple steps now, you can get into the habit of saving for retirement and making smart investments along the way. And that's it for this video. Thanks for watching.